Do you believe that low interest rates alone cause surging commercial real estate property values? Think again. In the early 2000s, the Federal Reserve slashed rates from historic lows, dropping them from 6.5% in 2000 to 1.75% by the end of 2001, in an effort to stimulate a faltering economy. Yet, despite these aggressive rate cuts, the commercial real estate market faced significant challenges, underscoring that low rates alone do not dictate property values. In 2001, commercial real estate was getting crushed. And even after the Fed slashed interest rates, prices still didn't go up. Here's why cheap money did not save the market.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets. This closing bell might as well have been an alarm, so savage was the selling. In percentage terms, it had less impact than the crash of '87, but it still left traders and investors shell-shocked.
In the early 2000s, the dot-com bubble burst, and it didn't just shake up the stock market, it hit commercial real estate like a wrecking ball. Overnight, tech companies that had been burning through venture capital collapsed. Startups disappeared. IPOs were pulled. The NASDAQ lost nearly 80% of its value. But here's what that meant for real estate. In tech-heavy markets like Silicon Valley, San Francisco, and Seattle, demand for office space didn't just cool, it collapsed. Thousands of companies closed shop, and the space they left behind, it didn't just go dark, it hit the market fast through subleases and bankruptcies. Sublease space flooded the market, driving down rents. Vacancy rates soared into double digits. In some submarkets, more than 20% of space sat empty. And while interest rates were low, it didn't matter because the tech engine that was supposed to drive demand had stalled. There was no tenant base, no growth narrative, no rent roll to finance. For landlords, it meant lease renegotiations, lost income, and evaporating asset values, not because of rates, but because of demand destruction. And that's the lesson. Even in a low rate environment, if the tenant base vanishes, values follow. Then 9/11 hit.
Certainly people are streaming out of buildings in lower Manhattan. We can now tell you that there's not going to be trading on the New York Stock Exchange. They're evacuating the New York Stock Exchange. NASDAQ was hoping to start its computerized trading day about 2 minutes from now at 10 o'clock. We don't know if that's going to happen. To this point, the White House, the Capitol building, the State Department, the Treasury in Washington, all evacuated after the blast struck the Pentagon. Manhattan is sealed off. If you want to get in, you cannot at this point in time.
As if the dot-com collapse wasn't enough, then 9/11 happened. The attacks didn't just shake New York City, they sent shockwaves through every corner of corporate America. Boardrooms went silent, expansion plans were shelved, travel frozen. And when it came to commercial real estate, nobody was signing new leases. Tenants were in survival mode. Businesses were suddenly focused on risk, not growth. Office leasing activity across the country came to a halt. Deals that were in motion died instantly. Pipelines dried up. And then came the ripple effects. Security costs surged. Insurance premiums skyrocketed. And for many landlords, operating expenses ballooned overnight. But revenue? That was going the opposite direction. Companies were downsizing, consolidating, or delaying any commitments altogether. And just like that, cash flow became fragile and valuations followed. The message was clear. Even with low interest rates, fear and uncertainty kill momentum. You can't refinance optimism. You can't lease empty space to anxiety. And no rate cut in the world can fix a market paralyzed by crisis. Next came job losses and corporate pullback. And just as the dust was settling from 9/11, the next wave hit. Massive layoffs and corporate retrenchment. Across the board, tech, finance, media, manufacturing, companies slash headcount to preserve cash. Hiring froze, budgets tightened, and with fewer employees came a new reality. They didn't need as much space. Suddenly, those expansive corner offices and full floor leases didn't make any sense anymore. Businesses started to consolidate, subleasing excess space or moving into smaller, more efficient footprints. Open floor plans replaced private offices. Regional branches were shut down, and tenants became far more cautious, opting for shorter-term leases, more flexible arrangements, and fewer commitments. What was the impact on landlords? Less demand, more vacancy, and tenants with all the leverage at the negotiating table. It wasn't just a dip in occupancy, it was a structural shift in how companies thought about space. Even with low interest rates, landlords were facing rising vacancy, falling rents, and declining asset values because the demand drivers had changed. The story wasn't about capital, it was about confidence and contraction. And again, cheap money couldn't fix it. Here's why low interest rates did not increase property values. The Feds cut rates fast, but here's the truth. Number one, empty buildings don't care about cheap money. If there's no rent coming in, the building's worth less, no matter what the interest rate is. Number two, cap rates didn't budge, yet along go down. Investors demanded higher returns to compensate for risk, keeping cap rates elevated. That meant even with cheap financing, asset pricing stayed flat or went down. Number three, lenders weren't aggressive. Well, rates were low, but banks were still extremely cautious. Banks weren't aggressive about underwriting new loans. Capital was available, but not flowing freely. Deals just weren't getting done. Number four, the psychological impact of 9/11. Market fear and investor-reduced transaction volume, investors sat on the sidelines until clarity returned. The focus was on preserving capital, not deploying it. So what's the bottom line? Even though the Fed slashed rates aggressively post.com and post 9/11, commercial real estate didn't bounce back and values didn't go up. Why? Because low rates alone cannot fix weak fundamentals, poor demand, or investor fear. Until occupancy, income, or confidence recovered, pricing remained muted. I'm Brandon Michaels. I've sold billions in commercial real estate, and I've helped hundreds of property owners achieve their financial goals. Follow for real insights that help you think like an investor, not just a headline reader.